Hello, everyone, and welcome to another edition of Inside Investing, the show that helps you level up on your financial knowledge and sharpen your investing skills. I'm your host, Nugwa Haruna. We've got a fantastic conversation lined up for you today about dividend investing, and I'm really excited to dive into that. It's often thought as a slow and steady approach to building wealth over time. But like a snowball rolling down a hill, a little bit of dividend income compounded over time can eventually grow into something that's much larger. But dividends can be much more than just a source of income. You'll be surprised to learn just how impactful dividends have been to the total returns of the broader market. So let's take a look at the S&P TSX Composite, for example. Dividends have contributed more than a third of the benchmark's total return since the 1970s. And it's not just Canada. This is a global phenomenon too. So consider the MSCI World Index, which represents the largest companies across 23 developed markets. Roughly a quarter of its return is driven by dividend income. So history has shown us that dividends can be an important source of returns. But there's so many stocks to choose from that pay dividends. So which ones deliver the best goods for investors? Is it stocks that offer the highest dividend yields, or stocks that grow their dividends the fastest, or somewhere in between? So we're going to get to the bottom of this riddle with some help from today's speaker. And joining us today is Damian Fernandes, Managing Director at TD Asset Management. So Damian, thanks so much for being here with us today.
Thanks, Nick. We're happy to be on. Being also a client of direct investing, a longtime listener, first-time participant, so super excited to be on.
Yeah, so I'm excited for our conversation. So just before we hop into that, so can you tell me a little bit about your role at TD Asset Management and what your experience is with dividend investing?
Sure, Nick. So TD Asset Management, we're an asset manager with close to $300 billion of assets. I and the team, and I'm just the face of the team, manage about $60 billion of those across various strategies in Canada, the US, and global equities. Myself and my direct team, we manage US and global equities, and some of our biggest mandates we have are dividend mandates, the mandates such as U.S. dividend growth, or global tactical, which is a dividend balanced fund, or U.S. monthly, or even ETFs like TD Global Enhanced Dividend. All these mandates, implicit in them, is this philosophy of growing income over time. And that's really what was something I truly believe in a world constrained by demographic challenges. Having a growing steady stream of income alleviates, helps introduce some almost like insulation, where you're getting paid and where that payment is increasing over time.
All right, so thanks for sharing that. So for investors who are new to dividend investing, they may sometimes struggle to figure out what to focus on, if to choose between dividend yield or dividend growth. So why do you think they struggle with this?
Because look, when an investor immediately think about, if we're out shopping. If we're out shopping and we see, actually a lot of shopping's now online, but let's just even online shopping, or you're just out in the street and you see, you see the windows and they have things on sale, and immediately you're like, oh wow, that's at a discount. That's similar to a very high dividend yielding stock. That discount might be justified, right? In the sense that that high dividend yield is reflective of maybe some struggles in the business or some challenges, or maybe unjustified where the market has severely punished the stock, but there's true fundamental value. That is what high dividend yield is, right? And people look at high dividend yields like, I'm getting paid today a very high yield. The problem with that, or what I think sometimes people don't focus on, is the growth part, right? When you think about equity investing in general, just stocks in general, the value of a business is how much they can grow the cash flows that that business generates. This is the value of any business, right? Whether it's a private company, a public company, but in the stock market, which are publicly traded securities, the value of those businesses fundamentally is how much cash flow they're generating. So in a dividend growth strategy, what we're really looking for is that if the companies can grow their cash flows year after year after year, the dividend growth, the dividends will grow year after year after year. So implicit in a dividend growth strategy versus a high dividend yield strategy is that you have a balance, right? And like most things in life, right, balance is important. And you have a balance between income today, your dividend yield, but also some growth because that income is slowly growing over time. And I think that's a, that's a wonderful strategy that over time has worked quite nicely because that helps you, index towards inflation, which might be growing. In a high dividend yield strategy, that growth of that dividend might be somewhat curtailed because the businesses, the fundamentals might not be as robust.
All right. So thanks for explaining some of the fundamental differences between the both. But for those in our audience who may not have an understanding of what dividend yield is, so let's talk about what exactly is a dividend yield and what are some of the factors that may actually cause it to rise or fall.
Sure. Look, the dividend yield is just how much the stock is paying out as a percentage of income. Hopefully, the stock is, or the company you're looking to invest in is generating positive income. And the dividend yield is just a percentage of that income that is being paid out to you as cash. So, why would a dividend yield rise? A good reason why a dividend yield would rise would be is if the company is paying you out more income, right? Because it's the numerator in that equation is rising. The bad reason on why a dividend yield will rise is if the bottom, the denominator, the stock price falls, right? The income stays the same, the stock price falls, the dividend yield goes up. That's normally a warning sign. So dividend yield, even though you just see this number, right? You see a percentage. The stock is paying X percent of its, of its current price. It's really important to look at what's driving that dividend yield, right? Is that dividend yield justified? Are you worried that the stock price might be at risk or the dividend might get cut, right? All of those are components when thinking about dividend yield. But at its core, the dividend yield is just how much income the company is paying out to you as a shareholder as a percentage of the stock price.
All right, so I actually have a question from someone in the audience. So I want to address that question. So the question is from Ernie, and Ernie's saying, so I've heard some people say dividends are basically free money. So would you say that's true?
Like most things in life, nothing's ever free, Ernie. Even though I'd love it to be. When you think about a company that is paying out income in dividends, that means there's less income to reinvest back into the business. There's less income to probably expand operations. There's less income to maybe be involved in M&A. I like that discipline generally, Ernie. I do think that's important, right? Because if you're paying a dividend and you've consistently paid a dividend, it almost tells the management team, it forces them to have some commitment that, hey, every year we're going to continue to pay out X percent of our income as dividends. But it's not really free because there are other things the company can do with that money, right? It's free money in the sense that it's money that's left over after all the expenses and taxes are paid. But from there you can, pay dividends, you can invest in capital expenditures, you can be involved in mergers and acquisitions, you can conversely buy back shares too. So there is a cost to paying dividends, but I think that cost, and I'm biased as a dividend portfolio manager. I think that cost is sufficient because it introduces discipline for the management team.
All right, so I love how you mentioned that, right? So at the end of the day, that the dividends that are being paid out could have been used by the company to potentially expand itself, but it's giving out to its investors. So you may not necessarily consider it free money. It is benefiting you, but it is at a cost, as you mentioned. All right. So I know you talked about this very lightly, but how would you differentiate between dividend yielders and dividend growers, if these are terms for specific stocks?
Yeah, right. Yielders, look, there's no hard and fast rule. A dividend, and it ties back to the question that was asked. A high dividend yielder is a company that's paying a lot of its income out to you, sorry, a lot of this cash out to you as a percentage of its income. So assuming, let's just put some numbers there, right? Assuming a company generates $100 in net income, if it's paying out $80 to you in dividends, that means it only has, so that's a, that's a big proportion of net income. And maybe the stock is $1,000 stock, so that's an 8% yield. You're like, oh, that's a lot, but that means only 20% or $20 is left over for investment and everything else. A dividend grower, conversely, is a company that won't pay such a big proportion of its income out to you. It might be, instead of 80, it might be, 40 or $50 or something like that. So the actual yield isn't 8%, it's 4 or 5%, but then they have $50 left over where they can reinvest back in the business to keep growing that dividend yield over time. So there's no, like Nugo, I'd love to say that, there's a line in the sand between dividend yielders and dividend growers. There isn't really like a hard and fast line in the sand. For us, a dividend yielder or a high dividend yielding stock is a stock that pays out a big proportion of its net income back to its shareholders. And for us, a dividend grower is a stock that literally, like when you look at the history of the stock, it's consistently grown its dividend, right? Because it's almost like a commitment. If you're a management team and you've grown your dividend, yeah, over, let's call it a high single digit rate over time, every year to your shareholders, your dividends grown, between 6 and 8%. Your shareholders almost expect that from you, right? And so then the management team's thinking, okay, for us to deliver on that commitment to shareholders, we better make sure our business is growing 6 to 8% over time, right? And so there's almost this, when I talked about this idea about capital discipline, I really like dividend growers because it's almost this commitment to manage the business prudently to ensure that the income over time is going to continue to grow, which means you focus on growth.
All right. Okay. So we've been going back and forth about, dividend yield and dividend growth, and I know you went through a basic explanation on how to calculate a stock's dividend yield. But can we do that side by side? So how would an investor calculate a stock's dividend yield and then calculate a stock's dividend growth rate?
Sure. So really quickly, a stock's dividend yield is just take the annual payment in dividends and divide it by the stock price, right? If the stock, if like in my example, if the annual payment in dividends $80 and the stock price is $1,000, that's an 8% dividend yield. A dividend growth rate is, we can use, the last 1 year. We probably want a little bit more time, so say 3 years, just to give you some sense of history. So take today's dividend, like what the dividend yield, the dividend payment this year is going to be, and then compare that to what the dividend payment was 3 years ago, right? So let's just put some numbers to that. Assume the dividend payment this year is $100, and assume the dividend payment 3 years ago was $50. That means in that 3 years, the dividend growth has increased by 50%, right? So for us, that idea about, it's a little bit more, like, I don't want to say complicated, but just it's a little bit more, it takes more effort because you got to look at what, you're not just taking the dividend payment and dividing by the stock price. You got to look at the dividend this year compared to what was the dividend was, 3 or 5 years ago, and then calculate the difference. But that should give you some sense. If a company is raising its dividends over time, if you see that consistent dividend growth, you know that the underlying fundamentals of the company are also growing to support that dividend growth.
Right. And one of the nice things is a lot of the tools that you have these days actually just give you that percentage, right? So you
Yeah.
don't necessarily have to grab a calculator. So thanks for that, Damien. But I just wanted to just so people don't get scared in the audience. You can also utilize some of the tools as well. But it's always a good idea for you to have an understanding as to why this is important. And so that's why we're actually having this conversation on those calculations. So all right. So let's take a closer look at dividend yielders first. So, what would you say is the appeal of focusing on dividend yield?
Well, dividend yield is income, right? In a world for the last few years, outside of these, these last two more recently, the rate you were earning by just letting your cash sit at the bank or buying GICs, or even overall bonds, was actually very low. right? It was because you had you know quantitative easing globally. You had like rates were held low, so a high dividend yielding stock provided you with income. If it was a company that has a rich history of paying its dividends, it's to a certain degree that company management team views that dividend payment almost as sacrosanct. It's not going to cut it. So, the Canadian banks are a great example of this, right? That have over time have consistently paid and their dividends and actually have grown their dividends. So, in a world of low rates, which was the world we lived in for the last 10 years, excluding the last 18 months, a high dividend yield was an attractive form of earning income because the alternative was fixed income investments that didn't really pay you that much.
All right. So, still on that topic of dividend yielding, so what sort of investor might prioritize dividend yield in their portfolio? Because right now you just talked about in this current environment, there's the competition now. Because yes, we've had really low rates in the last 10 years, but in the year and a half, we've had some higher rates. So, what kind of investor may decide to prioritize dividend yield in their portfolios compared to some of the other competition that's out there?
Well, like, but I guess the an investor that needs a higher proportion of their income, like dividends are paid quarterly, so an investor that needs income today and a high proportion of their overall investments to return income to you, that investor. So this would be an older investor on a fixed payment, or an older retiree that's looking to that has a defined benefits plan. Those are investors which would look at dividend yield that and look at high dividend yielding stocks, because those dividend yields are going to be reoccurring at a consistent rate, and that will help support your whatever your income needs are at that time. So a high dividend yielding strategy would support investors who require consistent income over time.
All right. Okay, so there are investment products out there, such as covered call equity funds and closed-end funds that may offer very high distribution yields. Yet we sometimes hear about the dangers of chasing the yield when investing. So what does this mean, and what are some of the potential risks that come along with that kind of strategy?
Yeah, that's this is something that this is something that I really worry about, because a lot of these funds that you're referring to that have really high yields, that are using either derivative strategies or investing in companies that where the underlying securities that make up these funds have high yields. We got the question on, is it free? Nothing's ever free. The reason your yield is high is because the market is worried about the sustainability of your business generally, right? They're worried about like they're worried about that dividend. Like, how does you want the a dividend yield to go down, or to a dividend yield to reduce for the right reason? What do I mean by that? If you're a stock with an 8% yield that turns into a stock with a 4% yield, the good way of that happening is the stock price doubles, right? Like that's the good way of how you 8% yield goes to a 4% yield. The bad way of why that happens is if the stock price is that a dividend gets cut in half, right? That's the bad way, because then if you're an investor who's looking for a consistent, steady stream of income, and that income just gets cut in half. And so a lot of these strategies that, but we'll talk about covered calls separately, but some of these high dividend yielding strategies are actually have the underlying securities in them. Might not be the right securities for you if you're looking for consistent over income over time. If we switch that over to covered call strategies, what's happening in very volatile markets is that these strategies, the way they earn income is that they underwrite call options a little out of the money. So the market's moving up a lot and then down a lot. What happens is you're basically chasing the market, and you have to and yes, you're earning income from writing those calls or puts. No, but what's actually happening is that you have to buy back the shares. So you find a lot of the strategies. Look at the NAVs. All of these strategies have a published NAV that gets published every day, a net asset value of the underlying fund. And what you really want is a return on capital. What I mean by that is that the companies in your fund are paying out dividends, and the NAV isn't really moving. In fact, the NAV is growing because the underlying securities. You don't want a return of capital, which means that, hey, we're paying you a really nice high dividend yield, but the way we're getting that is that the underlying securities we own are paying a company, but we've promised you a yield that we cannot generate from the underlying securities, so we're going to pay you back some of your capital. That's almost
Right.
cheating, right? It's like, hey, I bought this at a NAV of X, but now it's X minus something to help pay for my yield that you promised me.
Well, that's a great call out as well, right? So investors want to be aware when they're getting those distributions off of whatever fund they're holding, they want to be aware, is it actually off of a yield or interest or, like you mentioned, return on capital, right? So thanks for calling that out. So I have a question here from Dennis. And so Dennis is asking, can you explain why dividends are generally significantly higher for Canadian listed securities versus those in the US?
Yeah, Dennis, that's a great question. And even if you're on the direct investing, site and you screen for securities, you'll find that in general, Canadian securities, global securities, European, Australian securities have higher yields than U.S. securities. And you might be wondering, why is that? It's because the U.S. market, there's a few reasons, tax advantages for the underlying companies, but the U.S. market is truly unique. I know the U.S. market's the largest market in the world, but it's truly unique in how it wants to pay back cash to shareholders. In the U.S., there's a high proportion of capital return of how the companies pay back their cash to shareholders. They'll use share repurchases to do that. Remember when I in the earlier question you had asked me, Nugo, like, what, what's the, is it free money? If you're not paying dividends, what else can you do? Well, you can buy other companies, you can invest, you can grow, you can invest in capital expenditure, or you can buy back shares. In the U.S. market is truly unique because of regulatory and tax rules, where a lot of companies might not even pay a dividend. And some of the biggest companies in the US, right? Like, think about the top, names in the US, companies like Tesla, or these are the top names in the index, right? Tesla, Alphabet, Meta. They actually don't pay dividends. But when you look at them, what they, so immediately, so they don't, you're not getting a cash return from those companies. But what they do is that they buy back shares with all the cash they're generating. It's a really unique structure. And so, the question was asked, like, why are dividend yields lower in the US versus Canada? I would say they're lower in the US versus most developed markets. It's because in the US, a lot of the cash that the companies generate, they will, they've used that cash to buy back shares. And it's a facet of time and capital return in the US where that has been, the preferred way of returning cash back to shareholders. Look, to be clear, when we speak to companies, we always ask them, it's like, when are you going to pay a dividend, or how are you going to pay a dividend? Because I really do like dividend yields, but it's just that the marketplace in the U.S. It's fine, it's comfortable with the capital return to shareholders being in the form of share repurchases, and ideally, like, if you're an investor, I guess you could say that if the company's buying back its shares at a discount, and that's moving up the share price, I could sell some of those shares to achieve my income. It just gets more. Much rather have a dividend yield because it's less complicated.
Right. Okay. So thanks for that answer. And Dennis, I hope you got the answer you're looking for. So before we continue our conversation, we have a poll on screen. So take the time to respond to the poll there. The question is, what kind of investor are you? So are you a dividend yield investor, dividend growth? Do you try to balance both, or you're still trying to decide, and that's why you're attending this webinar? So let us know what your answer is there. All right. So Damian, let's now move our conversation on to dividend growers, right? So, why would you say there's an appeal when it comes to focusing on dividend growth?
Oh, look, for the appeal, like, at the start, right? We were talking about what the value for business is, right? The fundamental value for business, and the value for business, whether it's a private or public business, is how much cash that business is going to generate, how much cash it's generating today, and how much cash it's going to generate in the future, right? And so that is, in your finance 101 textbooks, that's what it's telling you, that's what's worked out over time. The reason I like dividend growth is because if you're a company that's consistently paying a growing dividend over time, your management team has this informal commitment, right? Like a contract with their shareholder base that says, we will promise you an income that grows over time. And so implicit in that is that we will manage our business in a way that we will not be very focused just on paying you a high income, but we'll think about the growth prospects of that business to ensure that cash flows are growing over time to support that dividend growth. So in a dividend growth strategy, what you're really doing, right, is that, you have it right on here. What kind of dividend investor are you? The third one is balance. I like that term. I like that word balance because you're getting paid an income today, but that income over time is growing, right? And let's just put some numbers to this. Just, really like just think about a company that's paying you $100 in dividends, and that management team is going to grow those dividends 15%. In 5 years, if you do that over 5 years, that initial dividend of $100 will be pretty close to $200 if you've consistently grown by 15%. And so what normally happens over time, right, is that the market will look at a stock and say, hey, this stock has grown its dividend by, X percentage, 15% over the last 5 years. They will take up the price with it, as in the price of the stock will move up, right? So what normally happens is that you look at some of these, really large companies, both in the US and Canada, you're like, wow, the dividend yield is the same today as it was 5 years ago, but the price is up multiples. That's because the dividend yield has grown along with the price of the stock. And what we find over time, and there's empirical evidence of this, is that the stock price catches up to the dividend growth over time. So for us as a and I don't want to use these terms like growth and value and stuff. It's just that as a dividend investor, what we try and do is have balance. We want a dividend yield that is sufficient to meet to meet whatever obligations you might have, but we also want that dividend yield to grow because that speaks to the true value of the business.
And there was something important that you mentioned as to, the reason or the appeal of dividend growers. You talked about management's commitment, because we have indices like, the dividend aristocrats, right? And some of those require you to have consistently increased your dividend over time. The ones in Canada, I believe, is 5 years. In the United States, is 25 years of
Yeah,
consecutive growth, right? So that could be another reason why investors who start searching for dividend growers, these companies who are on these lists want to stay on these lists, right, Damien?
of course, right? And in the U.S., right? Because in Canada you have a higher. The reason why it's 5 and 25 too. And this is just a little bit of a segue. And it was that in the Canadian marketplace, a lot of the payers are. I love the answer. Just came up the screen and try to balance both. But a lot of a lot of the dividend payers in Canada come from industries like oil and gas or materials, where the underlying commodities are pretty volatile. So the reason why it's 5 years is because sometimes companies in Canada actually cut their dividends because the cash flows of the business are challenged because the commodity they follow is facing volatility. In the US, you have a more stable cohort. So in the US, the Aristocrats Index you talked about is 25 years. And think about that for a second, right? 25 years, the companies in that index, they every year they've paid that dividend, but more importantly, every year for the last 25 years, like clockwork, they've grown that dividend. So you have a pretty good cohort of companies within there, right? Where you have some confidence of growth over time.
Right. All right. So now we do have the answer to the poll there. So what kind of dividend investor are you? And I see that I try to balance both. Had almost 50% in our responses there, and coming in second is I'm not sure yet. So hopefully at the end of this segment you'll feel more confident about whatever strategy you decide to use. We have some dividend yielders, people who lean more towards dividend yielders, and a few of us prefer dividend growth. All right, so let's continue our conversation here, Damien. So now we've talked about some of these indices that actually track these companies, but what sort of investor will be that who prioritizes dividend growth in their portfolio? Because we can see from our poll results, just about 10% of people actually utilize this solely as a strategy.
Look, I think it's one of these things. I think an investor that doesn't need a really high income today, right, where which a high dividend yield, which needs a high income today, should have a dividend growth strategy, because implicit in that you're saying it's this idea about balance, right? If you buy you just non-dividend paying stocks, chances are some of those stocks might actually not be profitable. Right? To pay a dividend, generally, you have to be profitable to pay that dividend. So, in a dividend growth strategy, implicit in that is you're buying companies that are profitable, but you're also buying companies that are growing. Right, growing profitable companies. So if Nico, I'm pretty sure you've talked about a GARP, like growth at a reasonable price. This is dividend growth at a DGARP, right? Dividend growth at a reasonable price, because you're buying companies where you might not be receiving the highest income today, but you kind of have some confidence that that income is going to grow over time. And so an investor that this would appeal to, right, is an investor with a I don't put numbers to it, right? But an investor with a more longer time frame that doesn't have an infinite time frame, or isn't looking to make a quick buck, right, by trading stocks that are going to move a lot. Because generally companies that constitute a dividend growth benchmark or dividend growth index are companies with stable growing business profiles. So it might not be the sexiest companies right now, or the sexiest companies, of like they might not have but at least they're going to be less volatile, because the underlying cash flows that they generate are less volatile, which allows them to pay that growing dividend. So those investors would have a longer investment horizon, but they should also be investors who care about income, right? They care about income, but they can at least have some flexibility on time horizon of that income, because they know that over time, that dividend growth, that income they receive, will be growing over time.
All right, so it's almost like the consistency of that income, right? Because with
Exactly.
that dividend growth, yeah, there's that potential that we know companies are not obliged to pay dividends in the first place. But if you have these companies who have almost like made this commitment to keep growing their dividend, those kind of investors may consider like, the dividend growth strategy.
Sure.
So for an investor who's utilizing that, what are some of the financial metrics that they would be able to use to assess a company's dividend growth potential?
Sure. Well, one of the easiest financial metrics to look at, right, is just ensure that the company is profitable. By that I mean, it's like, is this company, over every year, is it generating you positive net income, right? Positive cash flow. Because if a company is profitable and that profitability is growing, right? You look at net income today or cash flow today and look at it 3 or 5 years ago. If the net income today is higher than it was 3 or 5 years ago, and that company pays a dividend, chances are that dividend's grown over that time, right? Because it'll want to grow its dividend with. So it's almost like, think about this as a subset of quality investing. You want to find companies which have positive net income, positive cash flow, where those are growing over time, and where the company has a commitment, or it doesn't even have to have a formal commitment. If there's a dividend yield and the company is growing, chances are that dividend is also going to grow over time. So the first thing I would look at Nugwa is ensuring that the company is profitable. The second thing and I know TD direct investing has this, I'd look at leverage. And by leverage, I just mean like how much, like how is the company funded? If there's a lot of debt on the balance sheet, right? The bank gets paid first before you get paid as a shareholder, right? That's what happens. If a company has bonds issuance, they supersede. So if a company has a fair amount of debt on, it's holding a lot of debt, the dividends that you might expect might actually have to be paused, or the dividend growth might actually be lower, because the company has to pay back that debt first. So, well, you look for, the first thing I'd look for in finding a dividend growth strategy is companies with positive and growing cash flows and earnings, and which should support dividends. But I'd also look at leverage metrics to make sure that they're not overly too leveraged, because that could affect future dividend growth.
All right, so now let's look at things on the other end of the spectrum. So what would you say some of the potential risks are for investing in dividend growers?
Look, the potential risks for investing in dividend growers is, I'll use, as I said at the start, is the my sandbox, the mandates and the funds I manage are generally U.S. and global funds, and one of the risks in if you're solely a dividend investor, whether you're a dividend yield investor or a dividend growth investor, I'm speaking even as a dividend growth investor, is that if you're in the U.S. market, a lot of the companies year to date that have done really well, and the biggest companies in the U.S. that are up anywhere from 50 to 200% don't pay dividends. So there is like, look, over time these things will normalize, and a dividend growth strategy, because you're focused on growth, will work out. But as a dividend growth investor, one of the things that because you're still focused on dividends and companies that pay dividends, is that you might miss out on companies that use share repurchases to buy back shares, or some of these high growth companies that aren't really profitable, that are doing really well. So that's the first the first pitfall. The second pitfall as a dividend growth investor is that because the yield isn't as high as a high dividend yielder stock, but and because rates more recently are rising, sometimes there's, at least in their in an interim basis, what might happen is the market might say, hey, I want but like maybe a 2% dividend yield that's growing 10-15% a year is not enough, and maybe I want that yield to be 2.5 or something. So there is some risk, especially with the way rates, I'm talking about fixed income rates, the yield you're earning. If those move, that might impact it. But look, the words I love to use all the time are like time and compounding. What I mean by that is that if you are a longer term investor, you have time in investments, and you believe in the value of compounding, as in dividends growing over time and cash flows compounding over time, it takes care of itself. It's that it might not work out in the next 6 months or the next year, but if you're finding companies where you have consistent dividend growth, chances are, to my example earlier, you buy a stock 5 years ago and you buy a stock today, and the stock price, the dividend yield is 2%, but the stock price is up a lot. It's because that stock price has moved in line with the dividend growth, right? So over time, these
Right.
strategies have shown to be a good risk adjusted way of building wealth, but also providing you income along the way.
All right. Awesome. So we have another question. And so Narendra is asking, is there a way to find dividend growth rate in web broker rather than doing it ourselves? It's a great question, Narendra. So what I'm going to do is I'm going to hop into web broker actually. So give me a second. I'm going to share my screen and we'll take a look at how investors are able to screen for companies that pay dividends. So you get the chance to choose what exactly you want, the criteria you want to use. We're going to incorporate some of what Damian talked about today. And this webinar will be available on demand, and you will be able to watch it, pause, rewind, practice what you're seeing. So, all right, so you should be able to see my screen right now. So this is WebBroker. So once in WebBroker, you want to click on Research. You're going to go under Tools, and you will go Screeners. So the Screeners tool is a tool that allows you filter for information that is important to you. One of the really great things about the Screeners tool is if you're not comfortable doing creating a screen yourself, you can actually use some of our preset screens here. So if you want some help getting started, under the preset screens, we have some for dividends. When I scroll down, you'll see we have some for top dividends. So these are stocks that are paying and growing their dividends for shareholders. We also have for investors who practice value investing, but also want companies that pay dividends, there's undervalued dividend payers. So you can use some of these preset screens, criteria already input for you. But today we're going to create one together, and I'll make it as simple as possible. So once you're on the stock screeners page, you're going to click on here where it says screening. Typically, what will happen is the screeners tool will come preset. And so we want to clear all. And now we have a blank slate. So we're going to go more criteria. So once I click there, we're going to go where it says dividends. So focusing on what Damian and I discussed today, we're going to look at dividend growth rate, but we want to look at it over a longer time frame, so 5-year average. So once I click on it, you have both a minimum and a maximum. I'm going to focus my minimum on at least, let's say, 3% average growth rate in the last 5 years there. So now I have 1,200, just over 1,200 companies. I'm going to add some more criteria. I'm going to go more criteria. Damian talked today about leverage. So in this case, we're going to use the debt to capital ratio. And if you're not too sure what any of these terms mean, all you want to do is take a look at the right because it tells you exactly what these terms mean. So this is essentially telling you just how much debt the company is utilizing to fund its business. And in this instance, this is more percentage based. So we want a company there's actually as little leverage as possible. So I'm going to go with 0.35 here, right? Because in this case, the lower, the better. So right now we have 536 companies. We're still looking at the US and Canadian markets. And what we can do is we can just go here and just change it to the Canadian markets. Once we do that, we have 60 companies that meet our criteria. You can add a few more if you like, but I'll keep things as simple as possible. I'm going to scroll down and you'll find your 60 companies. You'll find the first 10 that actually match your needs. These are ranked by just how well these companies meet your needs. Now, finally, if you want to do something called a back test. So the back test essentially gives you an idea on how to calculate a portfolio that holds the top 10 results on your screen and compare it to an index. So in this case, we're going to do a back test and we're going to compare this to the TSX 60 index. So I'm going to hit calculate and I'll just leave it called the default name screen there. I'm going to go okay. It's just going to take a few seconds to load here. Once again, this is mimicking you buying and holding these companies for 13 weeks and then starting all over again. And once we do that, you're able to see that the top 10 companies in this screen actually will give you, if you held these companies for the last 5 years, would have given you a return of 25%. Same with the TSX 60, 25%. So in the long run, you still end up at exactly the same place, but keeping in mind you're also receiving dividends holding these securities. Now, so Damian, any comments here in terms of how these the top 10 performed based on our criteria compared to the TSX 60?
First of all, I love the technology. That as I learned something here all the time, and just how effortlessly you did that, Dugwa, that was impressive. Secondly, it's what you said at the end, right? It's look, you've managed to participate in market performance, right? With the TSX, while also receiving income along the way. And we a few of the questions that you had asked me earlier is like, what kind of investor would these appeal to? Investors require income, and yeah, and in this case, in income that's growing. You have done just as well in owning the strategy as you've done the market, but at least along the way, you've gotten your piece of cake too. I don't want to say you can have your cake and eat it too, but in a strategy like this, you can have your dividend cake,
Right.
and at the end of the day, you're at the same level, or if not a little better than the market.
All right. All right. I'm gonna just flip things over. We looked at Canadian. I'm just gonna flip over to the US side here. Once we do that, there's 400, just almost 500 companies that meet our needs. We're still going to filter now by the top 10. And I'm now going to recalculate. You'll notice you can only compare this to the indices that are applicable to the companies you filtered for. So now we're going to be looking at indices such as the S&P 500, which is a US-based index. And I'm going to recalculate here. We'll call it screen 2. So it's just going to take a second to load here. And so we just want to look at the difference in terms of the return on the US side. Sorry, it does take a second to load. All right. So now we have on this end, Damian, we're seeing that on the US side, you are up 34% in the long run. So that's a 5-year calculation. And then the S&P 500 index, that was up 58%. So what do you have to tell us about this when we see this difference?
Yeah, immediately you see and you look at that and you're like, oh wow, like I shouldn't have picked the strategy, because if I just owned the market, I'd have done so much better. The 5-year period you're talking about has truly, truly been unique in the US. The index you're referring to, the S&P 500, the third biggest name in the S&P 500 is Amazon, and the fifth and seventh biggest names, because there are two, are Alphabet, and the sixth biggest name is Facebook, the old Meta, which used to be Facebook, and Tesla's there, in the top 10, as is Berkshire. What's yeah, like these aren't companies that I have an opinion on. What I can tell you with all these companies is that none of them pay dividends. And over the last 5 years, all of those companies, by virtue of the pandemic, so an e-commerce growth or cloud offerings or social media, all of those companies have done tremendously well. So it was asked a question before, and I'm glad you asked me this before, Nugwa, just because it dovetails nicely into this. Right? What's the risk of a dividend strategy, whether that's a high dividend yield strategy or a high dividend growth strategy? Well, one of the risks is that in this really unique circumstance in the U.S. market, where over the last 5 years, the best performers have been companies that don't pay dividends, it is hard for a dividend strategy to keep up with the market, which is what you're seeing right now. In fact, I would go one further. And I would say, given I know the numbers and how much those big names are up, I'm actually surprised that a dividend growth strategy has done as well as it has. What it means to tell you is that you, as an investor who needs a consistent level of income, yes, you haven't done as well as the market, but you've done pretty damn well because you focused on growth in an absolute level, and at least you've got your income along the way.
All right. All right. So really great responses there. I'm going to continue our conversation. So Narendra, I hope that answered your question there. And okay, so now that we have a better understanding of, dividend yielders and dividend growers, Damien, let's try and find a sweet spot between the two. So what does historical data say about how dividend yielders and growers have performed?
Look, the historical data is, if you look at companies that pay a growing dividend over time, and you look at that in the US and you look at the last 30 years, oh, you have it right there, right? It's what you find is that the companies that grow the dividend yield the fastest over time actually outperform the market over time, which is actually quite an interesting observation. Conversely, the companies that grow the dividends the slowest over time underperform the market. And there's and this is like, because when you think about 20 years of data and think about all the events that have happened over the last 20 years, right? The financial crisis, the European debt crisis, our most recent experience with COVID. Implicitly in that, you speak a dividend growth strategy is talking about quality, right? A quality and basically like responsibility to pay a growing thing. So quality and commitment. Why do I say quality? Because those companies will generally have less leverage, right? Because they know that they have to pay a rising dividend over time. So in the financial crisis, when growth was, when the world was in a recession and companies had really had challenges in finding income, these companies had less leverage to begin with. These dividend growers. Conversely, right, in times when the last 12 years before our most recent experience, rates were really low. So a dividend growth strategy, right, was a really good alternative for you as an income investor to earn a growing stream of income over time. So, I look at the history and I think that dividend growth, remember I said earlier, like my two favorite words are like time and compounding. If you have a strategy of buying companies where the underlying cash flows of those companies are growing, and there's a commitment from those companies to pay back those cash flows in a growing dividend stream, the stock price usually follows that. And for us, right, like, or not for us, for me, I think that for a lot of investors which don't need a really high income today, but have some degree of flexibility to allow their investments to grow over time while also receiving some income from that growth, I think that's a really good sweet spot to be in.
All right. Okay, so now an interesting finding in your study is that neither the highest dividend yield or growth rate performed the best on a total return basis. So instead, it was a balance between the two. So can you
Yeah.
unpack that for us in a little more detail?
Yeah, but like there's just more to what I was saying, right? Balance. Like you don't want to be in the highest dividend yielders because this is dividend yield, right? It's because what generally happens is that you have a high yield for a reason, right? You have a high yield for a reason, and what that generally means is that there's risk in the business, right? The marketplace is the stock price versus its dividend payment, because that's what a dividend yield is calculated, is low. The stock price is low because the market's uncertain about the dividend being paid. And so what you want, if you're looking for, if you're more of a dividend yield investor, right? If you need a higher income on a more consistent basis over time, I wouldn't look at the highest yielding stocks. In fact, I would, view those stocks with some degree of caution. I would make sure that, the stocks I'm looking at are paying me a high yield, but at least have some, that it's not the highest yielding, because what generally happens is if you have the highest yielding stocks, in cases more often than not, that yield doesn't really, that dividend payment doesn't really grow that much, or in a really bad scenario, that high yield is indicative of a dividend cut down that the market's anticipating. The stock price is already low because it's expecting the dividend to be cut. So that high yield is almost artificial. And if the company cuts the dividend, you get a lower yield for the wrong reasons.
Right. Okay, so thanks for that. So now I'm going to hop into a question. So we have a question here from Douglas, and Douglas is asking or saying, does your decision between dividend yield and dividend growth change depending on your age?
That's a great question that Doug says. I think, in general, as like as I age, as everyone ages, your need for income increases. Right? It's your need for income because you are like your need for income increases because you probably are, as you get older, you're hopefully retiring, and you don't have that same degree of monthly income coming in from other sources. So there is some, in this question, there is an implicit assumption that as you grow older and your income needs increase, you probably need to focus more on dividend yield. You also because as you grow older, you're less focused on a big total return too, right? You don't have to, you have less time, or generally, is that like a higher dividend yield. So in that question, I do think it's, there is some, there is some reasoning behind it, is that because you as you get older, you want less, businesses that pay you a high yield, because you need that higher yield to sustain lifestyles, to provide monthly income, etc., etc. Whereas if you're younger, and I don't want to sound like ageist on this by any means. I'm just saying that generally, if you're younger and you don't need a high income today, you can allow that dividend growth and that compounding to take hold. So there is a rationale for it, and I guess in theory I would agree with that statement.
All right. Okay. So Maureen is asking, so how do dividends in ETFs work?
Well, they could. It's similar to, they could work multiple ways, and it's a good question, Maureen. In the ETFs, for example, that we manage, the dividends that are paid out are a function of the underlying dividends of the stocks we own. So the stocks we own pay a dividends. If as long as the stocks we own pay a higher dividend than the promised yield that you're receiving, everything's kosher. It's good, right? Like the stocks pay this dividend, we return that back to our unit holders, and things are fine. It gets back to a question you talked about, Nugwa, earlier about return on capital versus return off capital. Some ETFs promise you really high dividend yields. And you can look at this. I'm pretty sure you can look at this in direct investing on the website. You can actually look at what the underlying ETF holds, and if the underlying ETF holds companies where those really high dividend yields are at risk, or they're using, derivative strategies to pay you that income, what sometimes happens is that the NAV of that ETF, the value of that ETF doesn't really change much, or might actually go down because they, to pay for that high yield, they're actually, paying you back some of your original capital. So I would be very careful, like when I'm looking at ETFs that pay dividends. I would actually look at what the dividend yield of that ETF is, and I would compare what the underlying stocks or securities that ETF holds, to make sure that there's some balance, right? Between, like, there's balance between that the underlying holdings in that ETF are paying me an income that should support what that ETF income is paying me. That's, it's all continuity.
Right. And that's part of the, so when you're looking at the ETF fact sheet, right? Or you can actually go on the fund company and you can find the top 10 holdings within Webroker. You can find the top 10 holdings for that company to help you do some more deep diving. So we'll take one last question, Damien. So Yemen is asking, so there are GICs that are offering more than 5%. Is this an alternative to dividends?
Uh, it's a great question, right? It's that was asked. The I get asked this question by my clients all the time. It's that GICs are offering us 5%. Why? Well, the GICs are offering us 5% today, and you can have a 6 month term or a 1 year term. And what happens if the Bank of Canada, in the next 6 months or 1 year, decides that rates are too constrictive and decides to cut rates? When that GIC matures a year from now, it might not pay you 5% as you go to look to refinance that. But if you're buying a quality company, and most companies do that, if you're buying a quality company that pays you, just pick a number, 4% in a dividend yield. If it's a quality company, next year, that dividend yield will still be 4%. In fact, that dividend payment, because it's a dividend grower, will likely be higher. So the dividend yield, if the stock stays the same, will actually be more than four. If the stock goes up, it might be four or even lower. So, the question is, it all ties to income, right? The GIC is paying you, the number is 5%, but that's actually a percentage of your investment, right? How much income are you receiving back? And a year from now, when that GIC matures, there's risk you might not be able to earn that same level of income. But if you're buying a dividend stock, whether it's a quality high dividend stock or quality dividend grower, whatever that income is, a year from now, 3 years from now, chances are that income is higher. So it's a really great question. It's all about your risk profile. Obviously, GICs are risk free. You get your money back immediately. Stocks have underlying volatility. The stock price might be different from when you bought it, but over time, right? If you're investing in these quality businesses that we look at, we find that the stock prices move in line with the cash flow growth and the dividend growth. But it's a great question.
Thank you so much, Damien. It was really great having you, and thanks for helping us have a better understanding on, dividend yields and dividend growth, and finding the sweet spot between the two. So, do you have any final thoughts you want to share with us today?
Sure. Look, first of all, thanks to the audience. Like, this was like, there was great participation. I've got lots of questions that, on the fly, that we were answering, that I thought were really great. Something that just came to my mind that, when I was asked about the previous question is about GICs, was, oh, by the way, dividends are, it's as Canadian dividends that you receive from Canadian corporate companies are taxed more efficiently. If that's impact, I did think we should get that out there, because as an individual investor buying Canadian companies that pay dividends, you're taxed more efficiently versus a GIC, which is interest income. That's just something that came to my head that I didn't mention. But overall, I think this was an awesome presentation. By the questions that, from the inbounds, I love talking about this stuff. And I hope that over time, as people are using the web broker platform, you think about dividend investing or strategies, like, some of the stuff we manage that focuses on this, because I do think it's a great way to, time and compounding, build wealth over time.
All right, we'll keep that in mind. Time and compounding. All right, so thanks again for joining us. And so, for those in our audience, make sure to register for those live webinars that I talked about, and check out our library of on demand content available in the Learning Center and on our YouTube page. See you all next time.